Hi everyone, welcome to Excel in Excel. Today we're going beyond money-back policies and looking at insurance as a whole. Is insurance really an investment, or should it only be protection? Let's use Excel to find out. Insurance comes in many forms. Term insurance, pure protection, no returns. Money-back policies, periodic payouts plus maturity benefit. Insurance plus market-linked investment. Health insurance covers medical expenses. Most people mix insurance with investment. That's where the problem starts. Myth: insurance policies give great returns. Reality: insurance is for protection, not wealth creation. Let's prove this with Excel. Term insurance mutual fund. Term insurance premium, $15,000 a year for one forward cover. Invest $35,000 a year in mutual fund at 10% return.
Here, these are the outflows on annual basis, and there's a total outflow 50,000 per annual basis. And value of SAP will be 10% of the return. So we're calculating the end value of the SAP using the formula. And at the end of the 20 years, the value will be 22 lakhs. Total premium paid is 3 lakhs, and total SAP invested is 7 lakhs, and the combined IRR will be 7.05%. So we are paying 50,000 as a yearly payment, and at the end of the year, we are getting 22 lakhs as the one-time payment. So the IRR, which is nothing but internal rate of return for this particular investment, is 7%. Whereas if you see the ULIPs, if you are taking a ULIP for 50,000 annual premium for 20 years, the average net return for ULIPs is somewhere around 6% because of the insurance costs and other charges which are involved. And this is the value at the end of the 20 years, which is 19 lakh 49,000. So the IRR is just 6% over here compared to 7.05% over in the term insurance and mutual fund scheme. So I'm not suggesting to take any particular policy, or I'm not saying don't take any particular policy. I'm suggesting you to be aware. So you're not falling into this particular scam. Calculate the returns before investing in any particular scheme. So you will be knowing it better and you are in a better position.
Money-back policy. Premium, $50,000 a year for 20 years. Payouts, $50,000 every 5 years plus $5,000 maturity.
In this policy, we are getting some 50,000 every 5 years. And at the end of the period also, we are getting a 5 lakh as the maturity amount. So if you see the IRR of this particular policy, it's merely negative 1.71%. We are not even getting any benefit out of it. We are losing the money value of the money. So there's a negative net present value for this. We are paying more than what we are getting. So there's no benefit we are arriving out of this particular money back policy. We are comparing ULIP with the direct SAP also. The ULIP will provide a very less rate of return because of the charges and all, whereas the SAP in general can provide you 10%. And if you are investing in a good SAP, you can get 15 to 20% as well, depending on the market. So even in that case, the net result, net value which you achieve will be much higher in SAP compared to ULIP.
Insurance should be for protection, not investment. If you want returns, invest separately.
Thank you.